So these CEOs, these big bosses of these firms, will be held personally liable if something gets wrong.
Firms cannot double dip, as it's called, so they cannot charge both a fee for the cash held on the platform and at the same time take a margin on the interest.
Orbis outperformed kind of peers by an average 15 percentage points, so well ahead of everyone else.
Welcome to Heart of Wealth, your weekly pulse check on the wealth industry. I'm Sophie Downes, your host for this week. Today on the show we have a regulation double. The FCA ends its light touch era for crypto firms and cracks down on platforms quietly pocketing clients' cash interest. We'll also take a look under the bonnet of the UK's top performing multi-asset fund ranges. Joining me to unpack this are two Citywire journalists, Nour Azhar and Grote, alongside Kate Blatchford-Hick, Head of Consumer Investments Policy and Market Analysis at the FCA. So welcome everyone. Let's kick off with crypto. So Nour, this week, the regulator has called your crypto story the biggest change in the FCA's scope for at least a decade. Talk us through the headline changes.
Yeah, absolutely. You can't have a day without crypto these days. So the main things is that, after years of sort of back and forth and consultation with the industry, the FCA had decided that, we're going to draw the line. This is the new policy. This is what we've decided to do. So the headline changes, basic anti-money laundering checks are disappearing. So by October 2027, the same standards will apply to all the firms, crypto firms, as they do to investment firms. So, we're talking about consumer duty, COB, SMN, CR, operational resilience, financial crime frameworks, all of these firms will be exposed to it. The other changes are also the slashed stablecoin reserve. It sounds big, but essentially what it is, the emergency cash cushion required for stablecoin issuers has actually been slashed from 2% to 1%. And that's because the FCA is saying we've had consultation and the industry has said this is something that will give us more capital and will allow us to have a bit of a breathing room. And the interesting one as well is they've lowered executive liability threshold. So the line, this is basically for stablecoin firms to enter the strict sort of personal liability, they've dropped it down from 65 billion pounds to 20 billion pounds. And what that essentially does is strips away that sort of anonymity. So these CEOs, these big bosses of these firms, will be held personally liable if something gets wrong. So these are the main changes.
Mm-hmm. And what impact do you think this will have? Is this going to be a big boost for the UK crypto market, or is it going to be more of a regulatory burden? We
have to, I think, strip it back and say why they're doing it. I spoke to the FCA last year and they said around 12% of the UK population, which is about 7 million people, own crypto. And that's up from around 2.2% in 2021. And I'm sure the figure has increased since then. So there's a lot of people that own crypto. And so they have to regulate it. If you're an institutional, firm, you couldn't have really offered crypto to and added it to your portfolio without sort of with that risk and with that sort of Wild West, the image that crypto has. So by bringing it, digital assets firmly under the Financial Services and Markets Act, what they've done is that they've given the boost to the UK firms to say, okay, well now it's regulated and now you can offer it and with a bit of confidence. I mean, it's still a risky asset, of course.
And how does this final framework stack up against global markets?
There was a media briefing earlier this week, and David Gill, what he said is that we didn't transport a policy. We actually created something from scratch. So if you look up to Europe, for example, they've got MiCA, which is the Markets in Crypto Assets Regulation. And that's a massive one. And it's actually just finished its transition period yesterday. In the US, it's still a bit messy. You've got, all this sort of comprehensive, they lack that comprehensive federal framework, and they rely on the SEC. So the FCA is also applying this sort of strict, if you are going to target UK consumers, you do need to apply and you do need to, if you're going to promote, you do need to be regulated within that frame. I'm sure you've heard it before, Kate, which is, the FCA is slow. I hear that all the time when it comes to adopting new rules and regulation, but I think they needed to be a bit more thoughtful and like David said, it's a policy that they needed to think slowly about it. So, yeah. Yeah.
But how difficult is it for the FCA to kind of strike the right balance between protecting consumers and keeping the city attractive?
Yeah, I mean, it's a great description of what we've set out, so not a huge amount to add to that. But I think kind of generally what you'll see that we've done through the policy work there is draw on quite established regulatory principles and really adapt them to the realities of the crypto market in the UK, really trying to get that right balance in terms of some of those priorities that you set out there. What I would say is that in response to the comment about speed, our colleagues in authorisations are very keen to talk to firms through our pre-authorisation application service to get those conversations moving in advance of the gateway opening on the 30th of September.
Okay, let's stay with you but shift away from crypto now. So the second story of the week was the FCA moving ahead with its plans to apply consumer duty to investment platforms that keep a slice of interest on clients' uninvested cash. Why did the FCA decide that simply notifying the customer isn't good enough anymore?
Yeah. What we think is really important is that they understand the value that they're getting when they do hold cash on platforms. And just to be really clear what our expectations are, firms cannot double dip, as it's called, so they cannot charge both a fee for the cash held on the platform and at the same time take a margin on the interest. You can have one or the other. When a firm does take a margin on the interest rate itself needs to be really clear to the consumer alongside, or if the firm charges, then those charges need to be really clear as well. And when the consumer deposits cash on the platform, unless there's an instruction to invest, we want the firms to be able to explain to the consumer how much interest they will likely incur on those cash balances. So you'll see today a set of proposals in that area which really complement the expectations that we've already set out in relation to how firms should be thinking about that cash margin being compliant with the consumer duty.
Mm-hmm. And I mean, when we published this article, we had a lot of comments coming back from firms who were maybe a bit unsure about how to do this and what fair value actually looks like in practice. But I suppose a follow-up would be, okay, so this applies to platforms. Does it also apply to DFMs?
So the rules apply to platforms and to wealth managers as well.
Okay. Well, let's give regulation a bit of a breather now and shift our focus to where money is actually being made. So Dan, you've been looking under the bonnet of the UK's top performing multi-asset funds. I mean, first things first, how did you collate this data?
Yeah, so what I tried to do was to rank not just the performance of multi-asset funds, but multi-asset ranges, to see who's performing best, Vanguard Life Strategy or SJP Polaris, for example. So the data I looked at was the returns of about 1,100 funds, housing around £600 billion, and I was looking at the 6 sterling-denominated Morningstar multi-asset sectors, and then for like the all-equity funds in multi-asset ranges like Vanguard Life Strategy 100% equity, looking at those as well. And so for each of those ranges, there was 87 in total because I looked at those with £1 billion or more. I calculated the average outperformance of its sector. So each of those kind of single funds in each range looked at how much they outperformed their sector by and then averaged that out to give a single score over 1, 3, 5 and 10 years for each of the ranges to see who did best.
Mm-hmm. And who did do best? And I guess as a follow-up to that, were there any surprises?
A big surprise really over 1 year, I think, in that you had a relatively small active fund manager outperforming its rivals by a really substantial margin. So Orbis outperformed kind of peers by an average 15 percentage points, so well ahead of everyone else. It was down to the equity sort of portion of the portfolio, and it was positions in soaring chipmaker stocks like TSMC, Samsung, and positions in rallying gold miners. So I guess the multi-asset space has certainly been one where you have kind of giants like Vanguard Life Strategy, and that approach of multi-asset fund of funds investing in passives has definitely been the that's what's generated the most flows and been the most popular. But you still have some outperformance from active funds as well.
These rankings prove that paying a higher fee for active multi-asset managers is worth it?
Sometimes, which isn't a great answer, I know. Over most time periods, you do see that low-cost multi-asset fund of passives, so funds that are investing in tracker funds and ETFs, they have done really well. But it's not a whitewash. You do have some active fund ranges in there as well. So a notable one is St James's Place's Polaris range. That's performed really well over 3 years. That's got a mix of, so it's predominantly active with some passive in there as well. And actually another advisor fund range, U Asset Management, so that's run by Finley. That's also a mix, a blend of actives and passives. That's done particularly well as well. This is a period where that's favoured kind of passive investment because you've had the US stock market driving the bulk of returns, and within that you've had the Magnificent Seven stocks, and now kind of AI sort of taking off, and these are areas that active fund managers have traditionally sort of been underweight. So even in this kind of period that has favoured sort of passive investment, you do have some good performance from active.
Well, I think that's all the time we have for today. A massive thank you to our production team and to our guests, Kate Blatchford-Hick, Nour Azhar and Dan Grote. Thank you for watching. We'll see you next time.